Thank you for joining this webinar, which has been organized by Grant Thornton, Uganda. We are very pleased to have you here. So in the meantime, as we wait for all invited people to attend, we are going to have a short prayer led by myself. Lord Father, we thank you for this day. We thank you for the gift of life. Thank you for blessing us in each and everything we've been doing, amidst everything that has been going on around the pandemic and everything. We put this webinar into your hands. Let it be fruitful. Let it yield what the purpose is for. And I pray all this, trusting and believing in your Son, Jesus. Amen. So, as I earlier mentioned, this webinar has been organized by Grant Thornton. I am Chelsea Ndagire, an associate working here at Grant Thornton in the tax department, and I am going to be your moderator throughout this webinar presentation. So as you know, every year, towards the end of the financial year of Uganda, which is July to June, the Minister of Finance, Mr. Honorable Matthias Kasaija, reads the budget for the public, and it is circulated with the respective amendments and the economic analysis and the different sectors and what amount of money has been allocated to the various sectors. So yet again this year, on 13th June 2022, the Honorable gave us the budget, where the theme was full monetization of Uganda's economy through commercial agriculture, industrialization, expanding and broadening services, digital transformation, and market access. So it was a very big theme because the plans that government has for this country are quite many. As he read in the budget, the economy has reported to have increased by a percentage of 4.6 from our performance in financial year 2021. And our GDP increased by over 146, which has transitioned Uganda to a low middle income status. He also read a few amendments in the tax in the tax laws of Uganda, some which are going to affect many businesses, especially those in rental. We shall look forward towards those when we get to our tax presentation. We also have a new act that was passed into law, the Landlord and Tenant Act. It was finalized and accepted. So it is going to apply to all the landlords in the country and the tenants. This is going to be their act. And we're going to have a broader understanding of which sectors like power, electricity, petroleum, manufacturing, how much they've been allocated in the next financial year of 2022-2023. So we are going to have various presenters from Grant Thornton here take us through this budget, because the Honorable gave it in detail. They're going to give us a summarized, better understanding. And as you can see, our contents which have been displayed on your screen right now, we have the economic overview, which is going to be basically how Uganda performed in the previous financial year. We have our budget, which is going to be for the next financial year. We have the sector allocation, where we're going to have every sector discussed and what amount of money was allocated to it and how the government intends to improve it. Then we are going to have our different amendments to the current acts, which are present: income tax, value-added tax, excise duty, tax procedures code, East African Customs Management Act, the Tax Appeals Tribunal, and lastly, the Landlord and Tenant Act, which is new and has just been enacted. So as we proceed into this presentation, we are going to have a word from one of our partners here at Grant Thornton. Usually we hear from Mr. Anil or Mr. Shah, but today we've tried to switch things up a bit. We want to introduce our listeners and our clients to our other partners that we have in Grant Thornton. So our opening remarks are going to come from Mr. Uday Balhara. He's a partner in the audit department of Grant Thornton here. He's a certified chartered accountant in India, in Uganda, and in USA. He's operated in this business for over 14 years with high-profile cases. Some of you have interacted with him there, here and there. He has led numerous audits by providing leadership and project management, engagement teams, guidance on the IPSA applications, resolving audit queries, evaluating the accounting procedures. He has participated in numerous auditor seminars that have been held. He has worked in KPMG and now he's in Grant Thornton. So he is basically, that is a brief background about him. And he is going to give us some introductory remarks as we start this webinar presentation. Mr. Ude, I hand over to you. Please go ahead and give our guests.
Thank you, Chelsea. Good morning to all our clients, guests, friends, and GT staff. It's my pleasure to have you all here on this very important online webinar. So I'm very happy to see you all virtually. There are new faces on this call since we presented our budget seminar last year. Grant Thornton, Uganda is a part of a wider network spread over 136 countries across the globe. Grant Thornton, Uganda is a member firm of Grant Thornton International. We are a network of independent assurance, tax and advisory firm made up of 58,000 people in 136 countries. This is the era of technology and there are boundless possibilities of the future. We are blessed that we are born at the time of human history. At Grant Thornton, we go beyond for our clients and for our employees. We champion compassion and we create the history by providing valuable services to all our clients. As you are aware, Honorable Minister of Finance read 48 trillion budget in Parliament yesterday. And by now, many of you might have read, either heard about this budget. However, as you know, Grant Thornton is known for its detailed and practical update on the budget to our client. We do this by way of webinars and by circulating the budget bulletin. Over the years, our tax and advisory team has mastered the art of analyzing budget from various angles. I'm sure that will be very much helpful to you in one or the other way. Our presentation will include the overall analysis of economic performance, government interventions on various industries, tax impact on your business, and so on and so forth. We are truly proud of our tax and advisory team to come up with such an important budget webinar in just less than 24 hours. Without taking much time, let me hand over this presentation of today's webinar. Over to you, Chelsea. Thank you everyone once again.
Thank you very much, Mr. Ude. I'm sure our listeners appreciate hearing from you. As I earlier mentioned, this time we are introducing you to other key members of the management of Grant Thornton. So we've just heard from one of them. And I continue to welcome our attendants who have spared time to come and be present in this webinar. So as we move forward, we're going to dive right in. As I earlier mentioned, we are going to start with the economic overview and the budget allocation part, which is going to be led by Madam Himal Shah from the advisory department. She's a manager here at Grant Thornton in the department and has over 15 years of experience managing different sectors that require advisory. She has a broad portfolio in accounting, in manufacturing, in real estate, and I'm sure various people have interacted with her and found her to be very helpful. So she is going to take us and into the economic review of our performance as Uganda in the previous financial year. Furthermore, she will give us a brief and more understanding of what the Honorable Minister read about what to expect from our performance in the next financial year. So Himal, I'm handing over to you.
Thank you so much, Chelsea. Very good morning to all our esteemed clients and attendees of this budget webinar. To understand and appreciate the budget and its allocation to various sectors, it is indeed important for us to understand at what stage our Ugandan economy is and how was the performance of the economy over the last year. So let's look at some of the macroeconomic indicators to understand the state of the economy and its detailed pulse. So the first and the most important macroeconomic indicator is the gross domestic product, which actually measures the value of output of all the goods and services produced within a country in a year. The present GDP of the economy now stands at 162.1 trillion from 148.2 in previous year and 139.7 in the year before. This increase in real GDP is certainly a healthy sign of a developing economy. If we talk about the GDP per capita, which is measuring the economic output per person, this has also seen an increase from 825 USD in 1819 to 916 USD in 1920 to 936 USD in 2021, and essentially it has grown to 1046 USD in 2021. If we are to look at in terms of percentage growth, and we can go to the next slide, please. The growth in terms of GDP is 4.6%, which is higher than what was in the previous year as 3.8%. In terms of sectors contributing to this growth, we can see from the graph on the screen that the agriculture, forestry, and fishing has remained more or less a bit stable, but the industry, which had seen a bit of downturn during 1920 and 2021 has now started to recover, and so is the service sector. Going to the next macroeconomic indicator is inflation, and all of us are quite aware about the sharp and widespread increase in inflation across the basket of consumer goods and services. The headline inflation, which is essentially the total inflation, including the volatile commodities like fuel, food, etc., has rose to 6.3% as of March 2022. And the core inflation, which is excluding the volatile commodities, has rose up to 5.1% as of May 2022. These were essentially 2.7 and 2.3% in January 2022, and the target of central bank was to curb the inflation under 5%, but essentially the price increase in commodities like soap, cooking oil, food, fuel, transport have sharply risen, which has led to this increase in inflation. We've also seen the supply demand imbalances that were caused by COVID pandemic, and of course they are heightened more by the Russia-Ukraine conflict. The weakening of Uganda shillings against the dollar, the palm oil export ban from Malaysia and Indonesia, which is a key raw material for domestic manufacturing of some of the products, as well as the interest rate in the developing countries have all contributed to this inflation. I would like to indicate that the annual headline and core inflation are now projected to reach 7% and 6.1% respectively in 2022, going even to 8% in the second quarter of 2023 before they are anticipated to eventually stabilize around 5% back in 2024. Coming to the next macroeconomic indicator, which is the balance of payment. We know it is the difference in total value between the payments in and out of the country over a period of 1 year. This for Uganda can be highlighted through current account deficit, which comes when the import of the goods is higher than the exports. So the current account deficit, as we can see from the screen, is has increased to 3.6 billion in current year compared to 3.5 billion in previous year. Going to exchange rate, over the last year of 21-22, throughout the year, more or less, Uganda could maintain a stable exchange rate, and the exchange rate had appreciated in last year to an average of 3,548 against the previous years being 3,661, which was an appreciation of 3.1%. But we all know that since March this year, there has been a depreciation in the exchange rate. So we could see that from that average of previous year, there has been a depreciation of 5.7% in the exchange rate. And this is majorly due to the bearish sentiments over Russia-Ukraine war, and of course, the rising interest rates in the developed countries. Coming to monetary policy. Monetary policy actually refers to the use of various instruments under central bank's control to regulate and influence availability, cost, and use of money within the economy. So the main objective of monetary policy is to maintain the price stability. In June 2022, Bank of Uganda, the country's central bank, increased the CBR at 7.5% from 6.5, which was in April 2022. During the last year, the CBR was kept at 6.5 to meet the inflation target, and the inflation was much within the target. However, because of the rise in the inflation, to manage the price stability, the CBR has increased. We now move to the budget for 22-23. I believe the macroeconomic indicators have helped us understand the performance and the background to the budget. But let us go to the budget of 22-23 as read by our Honorable Finance Minister. So we all know that the historical allocations have been as we see on the screen. And this year, the amount of budget has been 48.13 trillion shillings to be distributed. We know the theme, like Chelsea rightly said, is a quite deep and varied theme, and of course it is in line with the National Development Plan 3, which is to range from 2021 to 2024-25. And of course, the budget theme and the focus areas are enhancement of security, the rule of law, and fighting corruption. The budget allocation to governance and security is about 7 trillion or 15% of the total budget. And of course, there is a separate allocation to fight the corruption. The next focus area is sustaining economic recovery, which is quite important when we have just come out from the COVID and economy has opened up. The third one is implementation of parish development model to create wealth and jobs. This has been considered as a key project, and for the last financial year, Uganda shilling 234 billion was provided to implementation of this model. And in current year, the Honorable Finance Minister informed that shillings 1.059 trillion has been provided for full implementation of parish development model. Each of 10,594 parishes in the country will receive about shillings 100 million. So it's a focus area certainly. Next is promoting agro-industrialization and standards and market entry. So agro-industrialization has been allocated over 1.4 trillion of the budget. Commercialization of oil and gas. Of course, we know the final investment decision made in relation to oil. Enhancement of transport, energy, and ICT infrastructure, which has received a 4.3 trillion allocation from the budget this year. And human capital development, science, innovation, and knowledge transfer, which has taken the highest allocation ever of shillings 9.1 trillion, or contributing to 19% of the total budget, which is a 17% increase from the previous year's allocation of 7.7. So that is a high-level focus area in relation to how the budget has been spread, or how the government focuses for this year's budget. We move on to the sector allocation and see how the allocation within each of the sector and performance of the sectors have been across. So the first and most important sector we consider is agriculture, because 80% of the land in Uganda is arable, while only 30% is used for being cultivation. So in 2021, the agriculture accounted for about 23.7% of the total GDP and 31% of the export earnings, which is a sizable amount considering our economy. economy. So 70% of the working population in Uganda is currently employed in agriculture sector. So we've seen the sector growth of 3.5% from the last year, and the focus areas or the budget allocated for agro-industrialization is about 1.45 trillion. Of course, this is slightly less than what was allocated last year, which was 1.67 trillion. But however, it accounts to about 3.17% of the total allocation. Through these funds, the focus of the government is increasing agriculture production and productivity, improving post-harvest handling and storage, increasing agro-processing and value addition, increasing market access and competitiveness of agriculture product in domestic and international market, increasing mobilization and utilization of agriculture finance. We are all aware that ACF is one of the modes to finance agriculture projects, and the cumulative ACF loan book as at 31st December 2021 is about 661 billion. So as government continues to support the agro-industrialization, it's also going to look at strengthening the institutional capacities and the industrialization element of agriculture. Moving on to the next sector, which is energy and minerals. The total budget allocation is about 1.6 trillion for both energy and minerals taken together. If we see or compare to the previous year, it is slightly increased by 40% from what was allocated in previous year. The energy allocation is 3.27% of the total budget, and mineral allocation is 0.07% of the total budget. The mineral exports and imports are one of the elements that boosts the economy as well. So excluding petroleum products, the mineral products in last year registered highest imports, totaling to about 2.17 billion. That is the growth in the imports essentially, which was in the previous year 1.09 billion. So more than 90% of this growth can be attributable to gold, which attracted a new tariff on exports in the previous financial year. But considering all other minerals and energy related projects, we are well aware that government actually plans to complete Karuma hydro plant and transmission lines in northern Uganda and DRC and South Sudan. The plan is also to establish a plant capacity of 200 metric tons a day in Masaka district to exploit the abundant pure white silica sand deposits at Demo Beach on the shores of Lake Victoria, and maintain the investments and continue the progress on exploration and quantification, as well as to continue offering support to steel industries and incentive to the mineral value chains. Moving on to the next sector, which is works and transport. There was a 15% decline in allocation to work and transport sector, particularly due to less roads being commissioned and more focus being given to the maintenance projects. In 2021, government undertook upgrading and construction of 27 road projects, totaling to 1,437 kilometers. The rehabilitation of Entebbe International Airport stands at 75%, and that of Kabale International Airport stands at 72%. Of the total 4.3 trillion allocation of the budget to work and transport, which is about 9% of the total budget allocation, the government focuses on upgrading and construction of the roads and, of course, rehabilitation of the Malaba meter gauge railway and Gulu-Pachwak railway line, of course, undertaking studies for Kampala-Kasese railway line, and, of course, construction of bridge and rehabilitation of KCCA works. The next sector is in relation to trade and industry. The industry registered a growth of 5.4% from the 3.5% in the previous financial year. This is majorly because of the admission of DRC into East Africa, which has opened up the market, commissioning of Mutukala Regional Market Construction, Green Manufacturing Strategy, National Industrial Database and Information Portal, which was launched, approval of development of Tangshan Bale Industrial Park and Laoshan Industrial Park in Kapeka, and reopening of borders and economies of EAC member states coupled with improved bilateral relations. Of course, we've also seen the economy reopening at the end of COVID, and we are sure that this allocation is going to support the noble objectives of government, which are quite apparent on the screen. In the interest of time, I will just move on to the other key sectors. The human capital development, as I indicated at the start of sectorial allocation, has taken up the major part of the budget, over to 19%, and it is split into health, education, and water sectors. This is 17% increase from the previous budget. The budget for governance and security has reduced by 40% from the previous year to about 7 trillion, and it makes up 15% of the total budget. Tourism has also been increased by 8% from the previous year, as economy is now open and tourists can easily come and visit the country. And ICT and digital transformation saw a decline in allocation of 8% from the previous financial year. However, the projects are under a progressive stage, which are part of the NDP3. So with that, I think I would like to end here a brief presentation on the economic review, as well as the highlight of the budget and sectorial allocation. I would like to hand it over back to Chelsea.
Thank you very much, Himal. I'm sure our listeners appreciate that. I continue to welcome you, our guests that have been invited to this webinar. I see the numbers keep increasing, and I'm grateful for the time that you've spared for Grant Thornton to listen to us. So Himal, thank you for that insight. She has given us a brief on the performance of the country, how the different sectors were allocated. We are happy that some sectors are still getting a moderate amount of money, for example, security, because I mean, the country cannot be secure enough. We thank the government for ensuring that that is always taken care of. ICT, as much as they've reduced the allocation compared to last year, but considering that the pandemic taught us so many things, we don't have to be physically present for everything. I mean, we're having this presentation online. Everyone is at the comfort of their homes. So they should have drawn us towards improving that more in the country, but I guess we shall try again in the next financial year. So we are going to move on to the tax amendments, which I'm sure everyone is eager to listen to. There have been various amendments in the different acts of the law, in income tax, in VAT, in excise duty. For those who are landlords, they are very, very eager to hear how their rental tax is going to be charged at these next financial years, because they've definitely made some amendments there. So I'm not going to take up much of Mr. Rikin's time. Mr. Rikin is our senior manager here at Grant Thornton in the tax department. He is certified chartered accountant in India, in Uganda, and many of you have interacted with him. He's on their tax consultancy cases here when you come to Grant Thornton, representation at URA. He's helped our different sectors, worked in various sectors like manufacturing, real estate, providing tax consultancy services, providing some accounting services that he has from his background when he was in India. So he has improved that here in Uganda with being here 15 years, and he's well versed with the Income Tax Act. So he's going to be taking us through the income tax amendments that have passed and were read by the Honorable Minister. So Mr. Rikin, I am handing over to you.
Thank you so much, Chelsea and Uday, for letting us through on what is expected out of today's webinar. Someone can confirm if I am audible. Okay. This includes how Grant Thornton Uganda is immensely capable of supporting the tax compliance and consulting needs of all of our esteemed clients. Thank you, Hemal, once again for providing a very insightful analysis on broader aspects of the economy, budget, and sectorial analysis. Good morning, all of the attendees of this webinar. My name is Rikin Shah, and I'm happy to be here and share my knowledge on the amendments that are expected to change the way we manage our businesses. You will all agree that managing tax compliances for any business are becoming of great importance these days. Well, in our opinion, this is not a coincidence. There are many events going behind the curtains, creating changes at both micro and macro levels. This requires the taxing authorities across the globe to make some drastic measures. In today's discussion, we shall try and discuss the logic behind these amendments of the regulations. With this background, allow me to run us through the amendments that are there in the Income Tax Act. So when I see the second section of the Income Tax Act, which defines the terms that are used in the whole of the act, I feel that is such a great way to start the complex regulation of the law. It tries to gradually sink you in and prepare you for what is expected in forthcoming sections of the law. As a layman, people may make mistake of understanding the importance of this section, but let me tell you, this could be a very important section of the act. Now, there are two amendments in these sections for this year, namely the change of definition of beneficial owner and the broadening the definition of exempt organization. As you can see on the screen, the definition of beneficial owner is amended. Without going into much of the language of the law, allow me to try and throw some light on what is the logic behind this amendment and its significance of this amendment. One of the intention of this amendment is to facilitate the automatic exchange of information. For many of us, this is not so familiar term as of now, but it will attract its due importance next year as Uganda is preparing to participate in automatic exchange of information from 2023. The Organization of Economic Cooperation and Development, OECD, is attempting to bring all the tax authorities on one platform for shaping policies that foster prosperity, equality, opportunity, and well-being for all globally. Under this mandate, there is a platform built called Automatic Exchange of Information. More than 135 countries have already signed off on becoming a member of this initiative. Now, this requires all the signing authorities to share the information between themselves fast and without much of the bureaucracies. In fact, the member countries are required to do so at the request of another member country. This amendment is in line with the OECD requirements. Another important impact of this amendment is on the preferential treatment of taxes under double tax avoidance agreements. Now, as we all know, Uganda has DTAS signed with 9 of the countries currently across the globe. And under those DTAS, there are preferential rates on some of the transactions that are happening across the border. So the benefits of these preferential rates under DTAA may not be available if the individual, that is the natural person, owing the company in this country of which we have the DTA, are not the residents of these countries. So if I may try and give an example that if Uganda is, if a company in Uganda is paying, for example, management fees to a company in Mauritius, since Mauritius has a double tax avoidance agreement with Uganda, there would be a preferential tax rate of withholding tax on this transaction. However, the definition goes into beyond this beneficial owner, meaning that if the Mauritian company's beneficial owner, which is a natural person, is not a resident of Mauritius, then the DTAA preferential rate will not be applicable. So this has a larger impact, and we can guide you as and when such transactions are required our guidance on case-to-case basis. If I can go to the next slide, another small change in the definition section is widening the scope of the exempt organization definition. Now, it is only last year that we had a welcome move by the lawmakers by adding the words whose object is not for the profit for bringing clarity into the definition. This year, the word research institution is added to the definition, which includes for a tax exemption under the Income Tax Act for non-profit research institution. By the way, we would like to remind you that donations made to these organizations are allowable deduction for the tax purposes to the extent it is less than the 5% of the taxable income of for-profit organization, that is our normal businesses. It is also worth noting that it is not merely based on the nature of the operation of the organization, and this exception needs to be operationalized with Uganda Revenue Authority. There are processes defined to get this exemption in place, and Grant Thornton would be happy to support our eligible clients on this process should they require our services. Okay, our next amendment is the elephant in the house. This amendment is probably with the most widening impact as compared to the other amendments this year. This amendment basically deals with the method of calculating rental income and rental taxes for individuals as well as for non-individuals. The individuals are now required to pay 12% rental tax of their gross rental income for the year over the basic threshold of UGX 2.8 million that we are all aware about. However, an important point is to be noted that no expenditure, including the mortgage interest, will now be allowed to individuals for the purpose of calculating the rental tax now and for the purpose of applying the 12% tax rate. For non-individuals that are earning rental income, a maximum expenditure and losses of 50% of the gross rental income would be allowed. No other deduction in form of wear and tear, interest, etc. would be allowed over and above this prescribed limit of 50%. Also, the excess expenditure over the 50% for the year would not be allowed to be carried forward for the subsequent year. With the applicable income tax rate of 30%, the best effective tax rate a rental income earner can achieve is 15%. Now let's try to answer why this amendment. There was a study conducted on the rental income regime and effective tax rate at which government could collect the rental taxes. As per the said analysis, the rental taxes in Uganda for the period between 2014 and 19 showed the average effective tax rate among the non-individual was 10.5%. As you can understand that the same is well below the 30% statutory tax rate on rental income of non-individuals, and even then the effective tax rate faced by the individuals. So in our opinion, the goal of this amendment was to create a simplified rental regime for individual taxpayers who generally do not keep records and increase the effective tax rate for non-individuals. We would like to state here that this is the interpretation of the amendment. We however foresee some practical issues for non-individual rental income earners or the developers, and maybe these questions would arise like what will happen to the previously brought forward tax losses that were generated as per the tax laws. Practically, will it be beneficial for a developer or a huge building or infrastructure project to forego its capital investment in terms of allowable expenditure in the spirit of building allowance? Does these taxpayers have to maintain supporting a piece of evidence to claim 50% deduction? What is the cost base of the taxpayer at the time of disposal of the property? So these are kind of food for thoughts for all of us, and we shall be getting the guidances from the revenue authority or from the lawmakers as the time passes and keep guiding our clients on the same. Okay, if we go to the next amendment, that is the amendment in the section 21. This can probably indirectly support the taxpayers, bringing their cost of operations down. This section is the exemption section is designed to provide income tax exemptions to certain type of income and certain type of taxpayers. In 2017, the Bujagali Hydro Power Project was given a 5-year income tax exemption, which was ending in June 2022. Although the initial proposal this year was to extend the period of this exemption up to June 2027, as we stand today, the period is extended only up to June 2023. That is one more year from here. If we see the significance of this particular amendment, the average cost of electricity for businesses in Uganda is approximately 14 cents per kilowatt hour. We have heard many times from the president that the country needs cheaper electricity for manufacturing and for the business to grow. And the goal is to bring down this number to 5 cents per kilowatt hour. This step is probably in the right direction. I would like to go to the next amendment. The next amendment is more of a clarification than the amendment to the law. Basically, URA has been emphasizing withholding tax deduction at 15% in the transaction where the income is derived from the carriage or of passenger who do not embark or cargo or mail that is embarked in Uganda. So this amendment is now clarifying that income earners from such transactions where the payments are made or services are provided by a non-resident contractors are not derived from a Ugandan source service contract, and hence the same needs to be treated appropriately. The amendment is aimed to clarify the position that no withholding tax, I repeat, no WST, is required to be deducted on payments made by individuals or non-individuals which are made to the carriage of passengers who do not embark, or the international transport of cargo or email or mail which is not embarked on in Uganda. This was always the interpretation of Grant Thornton's tax team, and the WST on such transaction would not be applicable. We as well provided guidances to many of our clients in past on this line. It is good that the act itself is now clarifying the ongoing tussle with URA, with the taxpayers and the tax consultants. This will be an event of past now. Okay, so that then the next amendment is in the petroleum and mining operations. It is levying the penalties for non-filing and non-submission of returns by a taxpayer running mining and petroleum operations only. As per this amendment, a licensee who fails to furnish a return or provide any other document required by the authority within the time prescribed by the Act is liable to a penalty of not less than $50,000, but not exceeding $500,000. Note that there are regulations available as Section 48 and 49A of the TPCA that deals with the non-filing of the returns penalties. However, these sections provide for penalties of approximately 20 million shilling. And as per the understanding of the lawmakers, this is not punitive enough for the petroleum and mining sectors operators. Although section 89QA of the ITA provided for a penalty, it was not clear which penalty would apply. Ideally, in resolving the ambiguity in the favor of taxpayer, the TPCA would have been applied. And this amendment is now clarifying that section 89QA of the ITA takes precedence over the section 48 and 49A of the TPCA for the licensee in the petroleum and mining sectors. That is the reason the amendment starts with the wording notwithstanding the previous provision of the section 48 and 49A of the TPC Act. Let me go to the next amendment. The next amendment is in the schedules of the Income Tax Act. There are two amendments in the schedule. The first schedule deals with the names of the organization embedded in the Act as an exempt organization. These organizations are exempt from income tax by virtue of the law, and unlike our discussion in the amendment of Section 2, these organizations do not have to operationalize their exemption. The amendment has added International Development Law Organization, and it also substituted the name of the DFID, Department of International Development, with the Foreign Commonwealth Development Office on the first schedule. This is due to the fact that DFID, which operated from 1997 to 2020, has now merged with FCDU. There is another important change in the part 6 of the third schedule, which deals with the rental tax rates for an individual. And it is starting the tax rate applicable for the rental income of an individual. We have already discussed the impact of the same in our previous slide, so I'll skip from here. Okay, the next slide is not an amendment to the act, but what was proposed as an amendment initially. So there are a few proposals that were there in the bills, but did not go through the budget process of approvals and did not become the law this time. It was intended to bring a blanket 10-year income tax exemption based on the investment amount, irrespective of the industry in which the taxpayer operates. It was also intended that 10 years of income tax exemption be provided to the investment made in setting up a hospital facility if the investment capital is more than $5 million, irrespective whether it's a foreigner or citizen. These amendments did not go through for this year. There was another important proposal for restricting applicability of section 118B2, that is only for the assets in the nature of land and building, and for including the transactions for purchase of land and building by the resident from another resident in the category of withholding tax exemption for compliant taxpayers. However, this as well did not see the light of the day this year. Okay, so with the above, I rest my presentations on the amendments in the Income Tax Act this year. Thank you for patiently listening to me. Chelsea, I request you to take this forward from here. Thank you.
Okay, thank you very much. We appreciate that. Please be reminded, I'm sure many of you have quite a number of questions. Our chat box is open. At the moment, we shall not be having any questions from you until the end of the session. So feel free to post your question in the chat box and someone can respond to you there. If you're satisfied with the answer, you can take that. If not, you will raise your hand at the end of the meeting and ask further questions. So as Mr. Rikin has taken us through the brief amendments which were made in the income tax with a detailed explanation. Thank you very much for that. And for those, especially the ones in rental, you will need a case-by-case basis. Please seek more guidance from us, seek more advice from the Uganda Revenue Authority on how this is going to operate. And as we also get to know how the Revenue Authority is going to put this in practice, we shall be getting back to you, our clients. But in the meantime, that is all we had for the income tax bit. So we are going to move on to the other part of the Act, the VAT Act, the excise duty, and the TPC Act. So this one is going to be presented by one of our managers in the tax department. He's called Mr. Agit Jangla. He has been in Uganda working as a tax consultant for over 7 years and a chartered accountant as well in India. And he has served many of you as well. A few of our clients have interacted with him on a day-to-day basis. Mr. Ankit is going to take us through the amendments that were passed in the VAT Act, the proposed amendments that are still under discussion for the Excise Duty Act, and the amendments which were passed in the TPC Act. So the TPC Act has some new offences that we should pay attention to when he gets there, especially for the introduction of the digital stamps, the e-freeze, okay? So there are some new offences that have been passed into law that are going to be affecting many of you if you do not comply with the requirements of digital stamps and the e-freeze system. So Mr. Kit, please go ahead.
So thank you very much, Chelsea. Thank you, my other colleagues, and welcome again to all the members who are over here in this call. I believe you would have, or you have had till now, a very insightful session, and I hope to do justice to the guidance or the education which has been given by my colleagues. And in that breath, I take forward the amendments to the VAT Act for the financial year 22-23. The very first amendment is to the section 20 of the VAT Act. Now, what is section 20? Section 20 currently states that any import of a service which is used for provision of an exempt supply, say therefore, when a taxpayer is engaged in business of supplying financial services, or say for that matter insurance services which are exempt from VAT Act, and any of the services which have been imported to render those services, there won't be any VAT on imported services, meaning there won't be any impact of VAT. Why VAT on imported services assume significance, as you all very well know, that it is at 18% and non-creditable. and also has to be borne by the importer of services. So it becomes a cost to a business operating in Uganda. Now, there has been some tweak and to this current legislation. What does new legislation say? That import of a service is only exempt if that service which has been imported is also an exempt service or exempt supply in Uganda, meaning that blanket exemption which was given has now been repealed, and that is how the section 20 has been amended. We request for our taxpayers who are more specifically engaged in banking or financial services sector, insurance sector, to write back to us or get our guidance wherever required at the time of procurement of such services. I move ahead to a next set of amendment, which is to the section 26 of the VAT Act. What is section 26 of the VAT Act? And before explaining section 26, I would give a brief background onto VAT Act. In simpler terms, VAT operates on an accrual basis of accounting, meaning any supply made or service provided, even though a supplier or a service provider has not received a payment from his or her customer, is supposed to make VAT payment by the deadline or of the subsequent month, which is 15th. But section 26 exempts certain categories of taxpayers from this accrual basis of accounting for purpose of VAT. Now, who are those taxpayers? One, the taxpayers whose taxable supplies do not exceed 500 million. To this category, there is one more addition. Here, it will bring cheer to many members or the many businesses who are attending this call. Why? Because a supplier who supplies goods or services to government can now also account for VAT on cash basis, meaning VAT on that supply is to be paid when he or she receives or the taxpayer receives the payment from the relevant government. This is done with an intention of easing out the cash flow burden to thus this kind of businesses who are engaged in supplying to government, because time and again it was observed that many a times there are delays in processing of the payments from the end of governmental bodies due to various challenges. Moving ahead to a next set of amendment, these are amendments to the schedules. So what are these schedules? Basically, broadly, the important schedules in the VAT Act are first, second, and third schedule. So you will see in my later part of presentation that there has been amendment in all these three schedules, which I would be taking the members through. But for this part, first schedule, what is first schedule? So the organizations listed in first schedule are entitled for VAT credit on the inputs being on the inputs, and also are entitled for applying for cash refund. So there has been addition, and this addition to the organization has been in sync with the Income Tax Act. So the Department for International Development is now going to be replaced with FCDO, as Rikin mentioned and gave the background to FCDO and DFID. And also there is one more addition, which is International Development Law Organization, IDLO. Moving on, second schedule amendment. Amendment to supply of menstrual cups. Over here, I want to, or I wish to take this amendment on the significance of amendment in my later part of presentation, because it has cross impact on both second schedule and the third schedule of the VAT Act. But we go to an amendment in paragraph RR. Now, what is paragraph RR? Currently, what is happening is any developer who has invested 5 million United States dollar in an hospital facility is supposed to get an exemption on purchase of certain kind of a services or certain kind of goods like feasibility study, design and construction, raw materials for construction of premises, etc. But this benefit is only tied if the facility is at the level of national referral hospital. Now, as we understand, there are only 2 national referral hospitals as we speak in Uganda. Now, the purpose of this amendment is to encourage more hospital facility development in Uganda, which are right now ongoing, and also to attract them, attract the investors in this industry. So to eliminate this restriction, the words at the level of national referral hospital have been striked off or eliminated, meaning any developer who is developing an hospital facility and has an investment capital of 5 million United States dollars can procure services, certain services or certain goods without VAT being suffered on it. So this is a very welcome move and will definitely reduce the cost of construction for the developers or the investors in this industry. And this is need of an hour, because we all have experienced in past 2.5, 3 years why the robust medical system is very important, and government is taking all the steps to see that the medical system is boosted in the country. Now, going forward, again sticking or remaining to the second schedule, again an oxygen cylinder or an oxygen for a medical use are exempt from VAT. So again, as I mentioned, the medical system or medical sector is the intention or the priority of government, and eliminating the taxes in the supply chain is one of the objectives. And in that breath, there are quite a number of steps which are taken. Again, supply of assistive devices for persons with disability. These devices for persons with disability, the VAT is now exempted on these devices. Again, this will impact or raise or it will make this equipment affordable to the persons with disability. So again, this is a very welcome move. Now, another move which is kind of related to a tourism sector and our beloved airline sector, which is Uganda Airlines being one of the major part of it. So the airport user charges till this point in time were waivable, and Civil Aviation Authority used to collect these charges from the customers and obviously lump up the VAT portion, meaning these charges used to make the cost of traveling expensive to Uganda or from Uganda. Now, to give fillip to a tourism sector, these charges are kept out of the VAT and to attract the tourism and to make tourism a bit more affordable. Again, right, making tourism affordable, it will also have an impact in boosting the revenues of our Ugandan airlines. Moving on to the amendments in the third schedule. What is third schedule of VAT Act? Supplies made or supplies falling under the third schedule of VAT Act are zero rated. So meaning any input tax credit incurred in making these supplies is eligible for entire refund. Now, there has been some proposals. Oh, sorry, take your pardon. Now there has been some changes to this third schedule. So first change is the educational materials. An educational material currently manufactured in Uganda is under zero rated schedule or zero rated supply. But now with this amendment, any educational material which is manufactured in partner state of East African Community will also fall under zero rated supply. This is in line with boosting East Africa and the spirit of boosting East Africa as one market. Over there, I want to take through the amendment on menstrual cups. I purposefully skipped this amendment at the time of taking you through the second schedule. So menstrual cups, previously they used to fall under the second schedule, are now going to fall under the zero rated schedule, meaning it is also one of the positive steps to boost or to promote the sector or the businesses who are into this item. This takes care of the amendments in the VAT Act. I have tried to highlight one amendment which was proposed but did not pass into law. And it's a good news or a positive news for the industry. Cotton seed cake are exempt from VAT, and it was proposed to eliminate the exemption or to take away that exemption, but the status quo has been maintained. So it is a good news for the operators in this sector. So this takes care of the VAT part of amendments. I move on to Excise Duty Act. Now, the Excise Duty Act has currently, as we speak, not yet been assented by President. So we have kept the proposed amendments on excise duty as it is over here, as Parliament further deliberate and debate on these amendments. But worthy to mention, the Honorable Minister of Finance during the yesterday's budget speech has informed to the country that there are some definitions of fruit juice or undenatured spirits and vegetable juice which were proposed in the legislation or Excise Duty Act has now been passed. So this will give a better clarity or better clarity on applicability of the excise duty on these items wherever these definitions or terms are used. I move on. I will not take much of the time of members in excise duty because they are still at the proposal stage. But again, Finance Minister mentioned that Parliament has passed the change in rate for OPEC beer, where the excise duty rate is now going to change. And from existing 12% or 150 per liter, whichever is higher, to 60% on shillings, 1,500 per liter, whichever is higher. So obviously these rates are going to change, and we shall track the developments on excise duty front, and we'll keep everybody updated through our publications or webinars of such sort as and when the topic evolves. Without going further into Excise Duty Act, I take you through the Tax Procedures Code Act amendments. The first amendment in Tax Procedures Code, before I take the amendments, the Tax Procedure Code is more sort of a law which is which prescribes or which guides on the processes or procedures to be adopted while implementing the other fiscal laws, other fiscal tax laws. So the first amendment is something which has bearing on people like us who are tax agents and who act in capacity of a tax agent. Currently, a registration obtained by a tax agent remains valid for a period of 12 months from the date of registration, but this is now going to change. The registration certificate, irrespective of it being issued, will always expire on 31st December of every calendar year, meaning a renewal or the renewal for registration has to be applied by a tax agent. So that was the amendment in Section 9. Other theme of amendments in the Tax Procedures Code Act has been towards the more stringent implementation of IFRIS or electronic invoicing system, and also the applicability of digital stamps on the products on which they are applicable. So in that breath, the very first amendment is to the penal taxes on up to now, the failure to affix the tax stamp used to attract the penalty, but now not only the failure of affixing a tax stamp, but also activation of a tax stamp, because the inventory movement or tracking of inventory is one of the core objectives of digital tax stamps. So once obtained and not activated, tax stamps are also going to be a subject matter of penalty, which are self-explanatory. Now, as I mentioned, the implementation of IFRIS and digital stamps is the core focus of the lawmakers, and URA in that breath is taking all the steps, including educating the taxpayers to the stricter implementation. So one such amendment is to Section 33, wherein any notice by a commissioner, obviously by a Uganda Revenue Authority through commissioner, if the taxpayer within the 15 days of that notice of compliance or to comply with the requirements of IFRIS and tax stamps is not making that compliance, then URA or the commissioner has all the powers to close down the premises of a taxpayer to bring him or her on the board to achieve those compliances. And the closure of such premises should not be exceeding more than 14 days. And once that compliance requirements are met by a taxpayer to the satisfaction of the commissioner, then the notice and the lifting of the closure of premises will happen. So that was the amendment or the core of amendment to Section 33 of TPC. Now, one more procedural amendment to Section 42, which will have a larger or a greater impact to many of the businesses. Now, this is to the businesses which are in the sector or functioning as a construction or an extractive industry. So any contract which has been entered for purpose of construction and the contracts given to the contractors needs to be informed to the Uganda Revenue Authority within 7 days of getting into such contracts. Making false or misleading statements will be attracting the consequences of penalty of Uganda shillings 110 million from the current penalty of UGX 4 million. There are certain offenses which are now included in TPC. Such offenses have been mandated in Section 62 of TPC. The basic theme, again, I want to repeat myself, is to encourage the on the board or the to the dot compliance with IFRIS and digital tax stamps. And also one more thing, any compliances which are mandated by Uganda Revenue Authority for purpose of automatic exchange of information, non-compliance to such will also attract an offense, and for which the fiscal consequences or financial consequences have been mentioned. Now, the payment to informers, currently it is at 5% for any informer who gives the credible information to URA on the tax leakage or tax unassessed by the authority is getting 5% of the remuneration against the information passed. But this is now going to be kept. One, there will be a segregation for identification on unassessed tax or duty. If that is the case, then lesser of 1% of 15 million. And if there is a recovery because of that information provided by Uganda Revenue Authority, then in that case, remuneration will be lower of 5% or 100 billion shillings. Obviously, this is not applicable to URA officers and staff. With this, I have been able to cover all the amendments in VAT TPC, and obviously some and the proposed background to a proposed amendments in excise. I hand it over to Chelsea in interest of time for her to enable other speaker to take you through the other part of amendments. Thank you everybody for patiently listening.
We appreciate that presentation, Mr. Ankit. I can see the chat box is full of questions relating to rental, relating to the new offenses in relation to non-compliance with digital stamps and IFRIS. Please, this webinar is to educate you, so you have been given the information. Make sure your company is properly complying, because those are the new call them the new kids on block in the URA. Digital stamps and e-freeze is very, very important. Also, those in construction, you have seen that every time you have a new contract with any service provider, you have 7 working days to represent URA with the information of all your contractors and subcontractors on your project. So for us to avoid the back and forth, the penalties that are going to come, that everything immediately, you've put in your project proposal and it has been approved and you've gotten everyone online, please just have that list ready and within 7 days it's at URA. So we are going to move on to the allied laws, which are going to be the stamp duty and the East African Customs Management Act, then the new Landlord and Tenant Act, which was enacted in Parliament. This one is going to be presented to us by Mr. Stuart Mulavi. He's an assistant manager in the tax department who's well versed with those sectors because he's attained his qualifications in tax both locally and internationally. And he's been with this Grant Thornton for over 7 years. So in the interest of time, I am going to hand over to Stuart to please proceed with the presentation.
Okay, thank you very much, Chelsea. I hope I'm audible before we begin. Okay, so we have a time constraint, so I'm going to try and rush through these remaining allied laws. So for the East African Customs Management Act, the new provision is that we have a 35% import band, and the items which is going to cover are shown on the screen. Just briefly, the reason for introducing this additional band was to basically promote local production and the local industries by promoting import subsidies, import substitution, and as sort of view. So just proceeding again, this 35% is basically going to promote local industries by discouraging imports of the following items. So dairy, meat products, cereals, cotton, textiles, and other items which have been highlighted here are going to be taxed at 35% effective 1st July of this year. So the second issue that I would like to talk about is duty remission. This is not something new. It's been there from time immemorial when it comes to import taxes, just basically a mechanism for subsidizing the import cost of raw materials for certain industries. As part of the presentation, we're going to share with you the full comprehensive list of the items which are going to be subject to remission for the coming year. Because of the time constraint, I won't go through everything. Maybe what I would like to talk about is the requirements which come after someone has accomplished applying for the remission. Some of our clients, and I think some of you in attendance, have always come to us during custom audit by URA is asking for the quarterly returns of the remission. So it's very, very important that after applying for the remission and if one is successful, they have to maintain proper records of the items under remission, how they're being accounted for and how they're being utilized, because it's a very, very important aspect of the remission accountability at the Customs Trade Department. Moving on very quickly to the Stamp Duty Act and the moving on to the Stamp Duty Act and the approved amendments have been shown on your screen. I would just like to talk about 2 important items on this particular presentation. The first one is changing the investment amount required. Now, if you look at that item in the excise duty law as it stands now, it's a blanket exemption for construction materials, which currently is tagged at 50 million investment requirement. Now, this is now been reduced to 35 million US dollars. Maybe I would just like to talk about that. This presents a lacuna in the law because other sections talking about income tax, VAT, don't have a blanket exemption, whereas excise duty has one. So I think moving forward is one area that we would like to lobby the lawmakers to either improve on or clarify. The second one I would like to just briefly talk about is the agriculture insurance policy. This is now being brought into the within the ambit of the Stamp Duty Act, but it's now basically it has come into the act, but without having any implications on this particular aspect. So that's moving on very quickly to the Tax Appeals Tribunal. The Tax Appeals Tribunal is basically our go-to in case CRA has failed to give us in case you're asked to give us an ear regarding all the objections and what have you. So currently the justice system and also the tax appeals tribunal is plagued with a backlog in terms of the cases which are outstanding. So in the most recent amendment, it has the panel of the tribunal is going to that is the board which basically makes the decisions is going to be increased from 4 members to 8 members, and about half of its members are proposed or basically are going to be ladies. So that's basically one of the diversity and inclusive requirements that the tribunal has been able to fulfill. So this move is basically going to improve the speed at which most of the cases have been decided, and in the process improving the justice and legal landmark in Uganda. Lastly, I think the most, can I say, crucial or the most sensitive act which has been finally passed into law is the Landlord and Tenants Act of Uganda. Now, this has been something which has been in the making for quite a number of years, but it has been passed this year. We all know the chaos which arose during the lockdown within the between the landlords and tenants and the issue of rent outstanding, rent payable. So basically, this law has been introduced to regulate the relationship between a landlord and a tenant. So we just want to take you through some highlights which have come because of this particular act. So it applies to all landlords and tenants except the ones which have been mentioned here. So you can see motel, hotel, transient lodging, basically temporal lodging won't be subject to this particular legislation. Tenancy through employment, where your employer gives you housing accommodation, that won't be subject to this particular law. And also residency because of detention, prisoners, medical, doctors, and the sick people, basically you won't be subject to this particular law. Going forward, as every law we have in Uganda, we have the section for definitions. I won't go very much in this because of the time constraint. Yeah, it basically is giving us a section which is going to guide between the tenant and landlord, who is basically required to meet what particular expense. Am I supposed to meet the Mayaka bill? The landlord, is he supposed to incur the bill of installing that that particular Yaka meter? Basically, who is supposed to meet what, and at what particular point in time this particular act is going to regulate that kind of system. The second one, sorry, the third one I'd like to talk about is the obligations of each person, that is the tenant and landlord. Basically, if you're tenant, you're supposed to keep your place clean. You're supposed to avoid nuisance, basically causing noise for your neighbors. And of course, if you're a landlord, you're supposed to provide a clean environment, which is supposed to be enjoyable for your tenant. So other duties and obligations have been outlined in the Act, I think we shall be sharing with you after this particular presentation. And I think the most sensitive part for most of our clients there who are dealing in real estate is basically the criteria for you increasing or decreasing rent. So one thing I would like to talk about is that you cannot increase rent by any rate which is higher than 10% between a 12-month period. So if you're charging someone per month of 2 million, in the next year you can only increase by 200,000. So that is basically the criteria which has been laid down. So obviously, in the circumstances whereby the landlord is decreasing the services which is providing to the tenant, they also have to follow that up with a decrease in rent. And like I said, this act stems from the chaos and confusion which came about in the first lockdown. Tenants and complaining about the rent paid and so what have you. So with this act now, it's regulating that the landlord has the the permission to enter one's premises in case they have defaulted on the rent bill due, and it basically gives a procedure to follow, first with the court proceedings and then entering the premises and then gathering any property which can be then auctioned off to pay the amounts due. So once again, I would like to apologize for the roller coaster that we've had to go through because of the time constraint. I haven't been able to talk about most of the things which would have been very key, but I would like to take it back to Chelsea and then we can proceed with the Q&A session. Thank you very much.
Yes, thank you very much, Stuart. And we apologize for having put a little time for this presentation. The link I shared in the group, please excuse me, it is for getting a participation certificate, not a presentation. The presentation is going to be shared with all of you at the end of this particular session. So we still have about 10 minutes left to the end. If anyone has any questions, please feel free to raise your hand, and we have 5 more minutes of a Q&A session. If you have any questions about the tax amendments, if you have any question about the economic analysis, please raise your hand and you will be given permission to ask the question. Alternatively, you can post it in our chat box and you will get a response from one of our managers here. Again, the link I posted was for participation certificate. It wasn't the link for getting the presentation that is going to be shared shortly after this. So anyone with a question, please feel free to unmute your microphone and ask your question while the call is still ongoing. Okay, it looks like no one has a question. Okay, one gentleman has put up his hand. Yes. Pakashan, please unmute your microphone.
Hi. Good afternoon to everybody. Thank you for a wonderful presentation and which will please.
Yes, Pakashan, please go ahead and speak.
Can you hear me? Hi.
Yes, we can.
Hi. Thank you for the wonderful presentation which give insight to the recent amendments briefly. So my question, maybe I don't know whether it is related to the amendments, this is related to EFRIS invoicing and EFRIS documentations. I was wondering if the branch operations, because URI is insisting that without the physical documents, the goods should not be moving and dispatching. So what document the URI would be looking for in case of transiting goods to branches, between branches, because invoices are not, cannot be generated in that case.
Prakashanji, good afternoon. Ankit here. Thank you very much for your question. We understand where you are coming from. See, what happens is in case where there are one business has a multiple locations and goods need to move to those multiple locations from a warehouse or a factory to the store or a retail outlet, then in that case, there is one facility available on the e-tax profile of a taxpayer where he needs to add all the places of business. Once that amendment is done, there has to be amendment made in the IFRIS system or IFRIS portal. And once those amendments are approved, the taxpayer will be allowed to facilitate or allowed to raise the inter-branch transfer invoices or the receipts, which will help as a proof whenever the goods are moving and if they are intercepted in the route or in the transit. So it's a process which we would be happy to help you with. You can approach us and we along with our business process sourcing team, outsourcing team, all will help you to navigate through this challenge. I hope I have answered your question.
Thank you.
We can take one more question from Mark Mutumba.
Hi, Chelsea, and thank you for the presentation. In regards to the rental income, I still wanted some small clarification. When they say the 50% cap and we look at the initial allowance that is given to buildings, according to the chat, I think it was, sorry, okay, I may not get into the name. I think it said it was still viable. So I wanted just to find out, do rental properties fall within industrial buildings, or does it fall under the practice note that talks about commercial buildings not being considered as industrial buildings? And then could you help me clarify with, I think it's section 22 that talks about that initial allowance that gives that initial allowance. Do you mind kindly helping me clarify that? Because we may need to understand this, because if the industrial building deductions are going to be capped within the 50%, I wanted to understand fully what the initial allowance that is being given, the 20%, will constitute for. Thank you.
Thank you, Mark. Jasmine is my name, Jasmine Shah. I'd like to answer your question. So first of all, 20% initial allowance is only available for an industrial building, and industrial building rental property will not fall within the definition of an industrial building. 5% allowance is what is called commercial building allowance, which has always been allowed on every property, including the property which is used for rental income. However, with the amendment which has come in this budget, all the expenditures, whether it is interest, bad debts, wear and tear, or building allowances, or any other expenses, it has been capped to 50%. So all your expenses, including building allowances, cannot exceed 50%. And on the balance of 50%, you are expected to pay the corporation tax. Hope I am able to clarify. Thank you.
Okay, thank you very much, Mr. Shah. Mark, in case you have any more questions, I've posted our email addresses on the chat box. I've also posted the location of our premises. You can visit our offices, and our consultants will give your company more help or more understanding on what has prevailed in terms of rental income. So we are going to move on and get our closing remarks and close this session in the interest of time, because we have about 3 minutes left. As I earlier mentioned, yes.
Chelsea?
Yes, Mr. Shah.
I think there is a question being raised by Sharon from Sibyl in relation to the imported services. I would like to request Ankit to please answer that.
Okay.
Thank you, Mr. Shah. Sharon, thank you for your question. See, with the understanding of your business, 1 minute, there is some echo. We are sorting out the tech. Okay. So Sharon, what happens is, supposingly say you are importing a service which is a software installation in nature. Okay. So if this service is the software installation services, if these services are exempt under the VAT Act, then when an import of that service is made, there won't be any reverse VAT, or the VAT at 18% non-creditable will not have to be paid. So meaning, what has to be seen or what has to be understood to determine the non-applicability of VAT at importation is what is imported and what will be the treatment of that imported service had it been supplied in Uganda. Okay, so I request for your set of business, because we are the tax consultants and we have come across various services. You can send us an email we will be able to respond to you on the specific services which you are looking the clarification for. Thank you.
Okay, thank you very much, Ankit. I think Sharon has appreciated that response, and I have also posted our email addresses on the chat box. So please, you can send us an email on those email addresses and we shall get back to you. So in the interest of time, I am going to invite another partner here at Grant Thornton, Mr. Nilesh Patel, who has been working with us for over 18 years. He is a chartered accountant here in Uganda and also in India with a master's degree, and he has worked in various sectors. He has a government sectors, donor-funded sectors, private sectors. He has given a lot of audit and financial reporting advice and quality control. He's a quality control reviewer. Basically, his CV is quite broad, and I will not get into that right now. But Mr. Nilesh Patel is going to give us his closing remarks, and he gives us a brief on his understanding as per what we've presented and what he hopes is going to be the way forward. So I will be handing over to you, Mr. Nilesh.
Good afternoon, dear clients, colleagues, and friends. We are towards the end of this webinar now, and I'm sure you must be willing to leave for your next engagement. But let me very briefly give my closing remarks. Let me start by thanking you all for remaining present in this webinar till end. All of us know that learning is never easy, and for that, all of you deserve a big round of applause. I hope you would have gained a better understanding of the area of budget update that you can use in your business. As we have seen, there have not been many new tax proposals, but the government has tried to work around achieving a better efficiency in tax collections. Many of us do worry that URA usually going behind taxpayers who comply. But I believe with the improved system of URA, they will realize this sooner or later and will work towards expanding the tax base. Let us also thank God for bringing back to us to this normal from what was last year at this time. With these few remarks, let me thank all the presenters of Grant Thornton and their team who worked tirelessly to put up this webinar. Thank you, and over to you, Chelsea.
We appreciate that, Mr. Nilesh, and on behalf of all the staff of Grant Thornton, we also want to thank you, our guests who have attended this webinar. Thank you for setting the time aside. The questions are there, and I know the questions are going to keep coming, but as I earlier mentioned, feel free to send an email, come to our premises, and those questions will be answered. We also want to thank our other partners, Mr. Jasmine Shah and Mr. Anil Patel, for the numerous contributions you have made towards the development of the farm, towards our career developments, and towards every single person. Thank you, Mr. Nilesh and Mr. Uday as well, for giving us your time today and participating in this webinar presentation. I want to thank all our presenters from the different departments in tax, in advisory, the ones who put together this presentation. And basically, I want to thank God for also allowing this to take place and giving all of us life. Thank you for your attendance, and we greatly appreciate it. Please feel free again to send us emails, approach us, bring us business. Our doors are readily available. We have very good rates. So thank you very much. Thank you for attending this webinar, and this marks the end of our webinar. Feel free to exit at your convenience.